Okay, a very happy Tuesday to you all. Hope you're all well and dandy. This is Rob Colville, also known as the Lazy Trader, presenting the central bank trade copy, a very straightforward strategy which you can mix both fundamentals and technical analysis. And for those of you who love trade, the kind of trade where you've got huge probabilities in your favor and you really don't have to do much, then this is the strategy for you, okay? And it's one which involves the people, the very people we love to hate, the central banks. Okay, so before we make a start, I'll just tell you a little bit very quickly about who I am and what I do. I've been trading for about 8 years now, and basically I've traded everything that works. For better and for worse, I've made every single mistake in the book several times over, and about 6 years ago, I became consistent, found my edge in end-of-day trading and on the higher timeframes like the weekly as well, and really found my groove, and my success in trading really snowballed from there onwards. Trading in a very certain or select way, and that was trading less but higher quality probabilities with high reward potential. And this is what this module or this strategy is going to give you: high quality trade ideas with probabilities and the odds stacked in your favor. Okay, so without further ado, let's get cracking. I would like to apologize for those of you who came and tuned in last week. I had a meltdown here in Putney Bridge, London, with technology. Technology, despite being born in the 1980s, I hate computers and computers hate me. So be it. It was never going to be a marriage made in the rose garden. So thank you for persevering if you did tune in last week and were disappointed with the no-show. Okay, so please, a bit of housekeeping. Do read the disclaimer, and we can continue onwards to the pith. Before we start, I would like you to make a note of this code here. You'll find out why later. Okay, it's something which will save you or potentially make you a lot of money. So write down October 888. You'll see why later. I'm going to hold you in suspense here. So let's make a start. The central bank trade copier. In this module, you'll determine the background of it, how to select trades, the timing of them, the management, and of course we'll look at potential trade ideas applied to this strategy. Okay, and there are lots of pros in favor of this strategy, and just to really name but a few, it's first and foremost, it's a unique blend of both fundamental and technical factors. We've got not only the context in our favor, but also technical reasons too, which obviously gives us a much higher probability outcome for that, and bearing that in mind, okay? With this strategy, we also have a variety of entry and management styles, depending on what kind of profile of trader you are. You might be somebody who's very risk averse. That's absolutely fine. There are ways in which you can profit from this. Or you might be someone who's quite gutsy and quite ballsy and appreciates that where there's risk, there's reward. Well, guess what? There's certainly a methodology for you as well with this. Okay, the great bonus about this, of course, is through trading this strategy, you'll be on the side of the market, which the biggest players in the market are as well. These central banks, they are the 10-ton gorillas making the moves or making the waves, and we are the little monkeys looking to basically scoop on to any move that's made. Us retail traders, we aren't the ones that make the moves, we're the ones that follow them. And if we've got an edge in the market and we know what way a central bank is actually trading, then we can hop onto that trend and do very nicely, thank you very much. And when they do announce, as we'll discuss in a minute, that they're defending levels, then we've got an extremely high amount of probability on our side. Another great thing is there are less rules to entry. You know, sometimes it can be frustrating when you get these strategies where there are 100 rules for entry. Sure enough, it eliminates the losers, but then you find yourself never trading. Well, even though this trade doesn't happen very often, there are very few barriers to entry. The reward potential is huge, and it really does reflect simplicity to its highest degree. It doesn't require any magic box indicator systems or anything like that, or that hocus pocus. It can be traded very objectively and on the hard time frames as well. Essentially, you can just set and forget No problem. The flip side of this, I always want to give the other side of the coin because, of course, nothing is perfect, and I obviously like to make sure that you know or fully aware of the kind of the downside as well. There isn't much of a downside compared to the pros, to be perfectly blunt with you. You can see that there are few opportunities. There really aren't that many. And the fewer rules to entry could provoke a fear-based disposition. I know some people do like to have a lot of rules before they jump into it, or sorry, not jump, enter into a trade. Okay, so this strategy really does hinge on what the big dogs are doing. The central banks around the Western world, in brackets. Of course, a lot of countries out there have central banks. We're only really interested in the Western world banks. And the reason is simply just because they represent the major economies and the currencies which are associated with them. And this is, of course, the European Union, that trading bloc, which, well, we're certainly in, despite what Nigel Farage thinks and wants. The Federal Reserve representing America, we've got the European Union and the ECB Central Bank, European Central Bank, the Swiss National Bank, the Reserve Bank of Australia, the Reserve Bank of New Zealand, and the Bank of Japan. These are the main banks which we can really peg to currencies which are popular pairs or popular crosses. And of course, you know, we could trade any other central bank. A lot of other countries have a central bank, like the Central Bank of Vietnam or the Central Bank of Afghanistan. But quite frankly, those currencies aren't particularly liquid. And I'll be honest with you, I've never actually looked at the chart of the Vietnamese dong before. However, I'm not saying that you shouldn't trade it. I'm just simply saying that we only really pay more attention to these central banks representing Western world economies, ones which have the clout behind them to really create the moves. They've got deep pockets, and when they say they're going to defend a level, then they really will be defending a level. They're the biggest players in the markets. And central banks, well, they are big influencers in the markets, not only from the domestic standpoint in interest rate setting and adjusting the base rate to help regulate or stimulate economic growth. The other reason is the reason which we are very interested in taking advantage of the central banks, and this is looking at the levels which they pledge to defend or even state that they are going to keep an eye on at defending. Okay, because frankly, if a central bank, like I just mentioned, says that they're going to defend a level, then they really do have almost limitless means to defend that level. And when they do that, we should get very interested in not getting in the way of their trade, not going short into a level which they've said that they will defend and push the price up. That's the last thing we want to do. We want to do the opposite and go with them. So if they've said they wanted to defend a level and stop, say, for example, if the Swiss National Bank have said that they want to prevent the euro, from getting stronger against the Swiss franc, and they'll buy the euro at any cost, we don't want to sell the euro on that cross bet. I'll discuss more a little bit later if you're lost. So what you're probably thinking, whatever. And you could be completely forgiven for thinking that. So how are we able to profit from this? Well, what we're able to do is essentially piggyback these big players in the market, these central banks who've got seemingly limitless resources to prevent price from moving through levels they've pledged to defend. Okay, so if price does come down, and we will look at examples, by the way, I'm a very visual person and I will give you these visual examples. If price does come down to defend a level, we can buy just above or on the level with a stop below it. Or if price does go up to test the defended level, we could sell just below the level with a stop above it. In fact, we can essentially take advantage of a previously tested technical level which a central bank has pledged to defend at all costs. So in this case, we have, not only do we have fundamental reasons behind our trading decision, i.e. the fact that the central bank have decided to defend a level or protect a level, we've also got a technical reason behind our trade as well, i.e. the fact that a certain level might have been tested. So when we're talking about the defended level now, we need to ask ourselves with this strategy, sure enough, it's okay if a central bank turns around and says that they're going to defend any given level in order to keep the balance of payments on their country or keep their exports competitive. But will it actually correspond with a technical level too? That's the burning question. And this is something we need to be very careful about if we're trading this strategy. So on one hand, the central bank might have pledged to defend a level, but is it a technical level? Well, this could be a level of support or resistance, which has had at least 2 prior touches. If we've got the central bank saying they will defend a level and it has 2 previous tests, then fantastic, we have a bona fide trade set up. If not, then we don't. Simple. We just walk away and find something else to do, whether it's walk our metaphorical dog or find a hobby or an interest. I've got plenty, and I encourage you to do the same rather than trying to look at the market and trying to think of ways to get into it. So one could say we've actually got the perfect storm with this strategy. We could trade on the daily and the weekly time frame. We could simply place the orders up and walk away and go on holiday and not care and just simply let the market take its course of events. And we've also got fundamental and the technical argument in our favor as well, like I just mentioned. Okay, so we've talked about selection, timing. Well, in terms of timing, selection, and management, the key elements of a strategy, then I just want you to ask these 3 questions when you're doing your independent analysis. Do we have a level defended by a central bank? Yes or no? Do we have a technical agreement, i.e. a level of support or resistance with at least 2 previous tests or touches? And yes or no? Or is price action heading towards this level or not? Yes or no? If the answer is yes to all these 3 questions, then we have a valid trade opportunity. Hooray! So let's take an example now. I know I've been talking on a long time now, but I'm quite a visual person as well. There's nothing quite like the real thing and seeing it right on the chart right before your very eyes. Okay, so we have the Swiss National Bank, who have just turned around and have said, well, they said several months ago actually, that they will defend the 1 spot 200 level in the cross-pair euro versus the Swiss at all costs. This is because for every pip a down euro Swiss falls, the harder it is for Switzerland to make exports competitively to European Union bloc countries. So this puts Switzerland at a key disadvantage. So in exporting their cheese and their watches and their chocolate and whatever else they make, wine no, they don't create wine. I don't know. Ski holidays as well. I jest. So from a competitive standpoint, they are at a disadvantage if their currency is strengthening against the country they are trading against. In this case, the European Union. So, oh yes, the Swiss make knives too. Beautiful country, by the way. I wish I'd lived there sometimes. But anyway, so every time this chart moves down, it essentially means that Switzerland is becoming less and less competitive against the euro. So the Swiss National Bank will possibly intervene at a certain level, which is pragmatic to them. Typically, central banks, not just the Swiss National Bank, will intervene at key levels, round numbers. 1 spot 200 is no coincidence. This is why we typically do get, or partly a reason why we do get, levels of support and resistance at big round numbers. These are typically levels which not just central banks, but major institutions, hedge funds, they have their stops and orders. Very obvious. But this one here, 1 spot 200, they have promised to defend it at all costs. So if the euro does fall into this level, then you could not be guaranteed, but you could be rest assured there's a very high, extremely high probability of the SNB actually shaking a leg and buying the euro in order to weaken it against the Swiss franc. So this is how the central banks can get their, actually have a use, really. I know we hear about them in the markets, in the news quite a bit in a very negative way, central banks and quantitative easing and backward flipping easing and all these new kind of like terms which certainly the Federal Reserve make up to make it seem to us that everything's going swell, but whatever. So as we can see here with the case of Euro Swiss, the currency pair here, which we were just discussing, the level which the SNB were defending corresponds with a technical level here. Admittedly, it's not the best, but we do have a very obvious looking level which price has just been unable to penetrate here all the way back several years ago, where we see this rather, I don't know if you can see my mouse moving, but we can see this tight consolidation. So we have the technical level correlating with the level that the central bank will defend. We also have another technical reason here as well, by the way, and this is where we can use our wider understanding of the market to really kind of like validate this trade even more. Even though, as we discussed, the central bank on one hand have said they're going to defend the level, great, but we've also established that there's a technical level there. Great, the trade's valid, but we do have an extra reason here, and this is the ABCD pattern here, which is where we have two legs equaling A to B, equaling C to D. They're equidistant with each other. We've got impulse, retracement, impulse, and this is essentially what an ABCD pattern is. And when we've got a bullish ABCD pattern where A to B does equal C to D, finishing or potentially finishing into a horizontal level here, then we can expect an upward movement thereafter. And that's what we're anticipating here, when all the stars of the universe could potentially line up. So forgive me for repeating myself, but I'm a great fan of repeating myself, not because I like the sound of my own voice, because I don't. It's just because it's a great way of learning. If you can think of it from almost like a subliminal standpoint, repetition is the key almost to success, where you're you're being told the same thing over and over again until you've got it. Okay, so on one hand, we've got the technical level here, which we've just mentioned. It's defended by a central bank, and it also is the level which a ABCD pattern is closing in on. So, of course, nothing is guaranteed in the markets. Anything can happen at any time. I know that there is a very good argument that if everyone knows or is going to be trading the same thing, there's no real edge. Sure, absolutely, markets can move in very counterintuitive ways, but if you can hawk it all back to the same kind of like cliche almost, and Warren Buffett always says this, and Jim Rogers as well, multi-billionaire, self-made, they'll always say, buy low, sell high. And of course, if you look at any currency pair or asset class, if we're at a multi-year high or multi-year low, then if we're at a multi-year high, that represents a very good selling opportunity. If we're at a multi-year low, that represents a very good buying opportunity. If we were to strip away all of the bells and whistles and just think along that logic, then without meaning to deviate from the central banks, then you could actually do very well from trading long term without being distracted along the way. But of course, a lot of people are distracted in their learning because there's always this kind of temptation to kind of try and discover what else is there out there and what more can I do? And there's this misconception that more is more, and the more trades that you place equals more money, and the more strategies you have equals some more money. But in fact, certainly a lot of people who've had their time on a saddle will disagree with that, myself included. Okay, so going back to if everyone has the same edge, the move is less self-fulfilling. Well, the fact of the matter is this is why I look for multiple reasons to get into a trade. Sure enough, it might be a level, great, whatever. But if we've got an ABCD pattern closing into the level, if the level has previous tests, or if it's a round number, or if it just happens to be a level which the central bank is defending as well, then we've got a pretty good case for a trade. And any trade that I do place, irrespective of whether it's a level which a central bank is defending, will have a case brought for the pros against the cons. Just like a argument is brought up to the House of Commons and Parliament, or any Parliament, the case for a law being passed, I kind of do that with my trades. And this is why I always kind of encourage having trading teams if you're trading the same kind of strategy. This is one thing I have going with my clients. We've got a very close-knit community here. So just to recap, just in case you haven't all got it completely etched into your mind by now, we had the great thing about this trade was we had the S&B saying they'll intervene at the 1-200 level for that cross pair, and we can see that it's already been tested several times before on the floor / level of support, and we have the completion of an ABCD pattern. Okay, and we do have other examples as well. It's absolutely fine. I just love being obvious. Quite frankly, obvious is better. A lot of people, certainly new clients that come to me, are very preoccupied in finding out what time is best on what the code is to go long on the Footsie. Say, a lot of people seem to think that it's what is there a certain day, a certain time of a certain day of a certain month you can go long on the Footsie and all of your financial problems will come to an end. Well, not really. Obvious for me is better. And even if we just hold back to supply and demand economics when we're looking at the charts. Okay, so let's have a look at euro dollar here. Just another European based currency pair, and we'll go into others live on the chart. they've said that they'll be extremely nervous if price or the euro does increase in value against the dollar at 1.400. This is the level which they've defended, and they have given very powerful signals that they will intervene again if price does come up to this level again. Okay, and we knew about it then, all the way back in February 2014. So as and when we got another opportunity to potentially short it, then we will take advantage of that, whether it's based on price action or based on just having an order on the level. We could do either or, depending on what kind of a trader you are. So you can see that we've got a previously respected level, like so. It says to multiple times. I think this is, yeah, certainly this is the daily. Sometimes it's better to look at the weekly to get more of a perspective. I mean, I would always recommend, in terms of looking out for what banks are intervening at what levels, I would check out sites like FX Street, obviously, Forex Live. I mean, if there's no secret out there, or no central secret kind of place or report you need to buy in order to determine the levels of what central banks are defending, it's quite common knowledge, actually. And even if we're not looking at levels being defended by central banks, I will say that a clue, big clue here, they're always going to be round numbers, 1.400. Anything with a double or triple zero in, or 550 or 500 in, is a great place to start, essentially. And you can also preempt these. So you can see here, euro dollar, look at this here. Not only do we have a horizontal technical level, we've got trendline resistance as well. So we are building up the case for a potential short as and when price comes into this level. It's not just, okay, the central bank's defending this level, whatever, fine, we'll just sell, close our eyes and bury our head in the sand. We've also got a number of other reasons to build up the case, okay? Because understandably, well, hopefully you'd feel a little bit nervous about essentially trading off a level with just one reason in support of your trade. Well, as many reasons as possible. There we go. Okay, so just to recap very quickly before we go on to do some live chart stuff. We have, on this case, the ECB, just to recap, we've got the 1.400 level, which is the level which the ECB will pledge to defend if price does creep up to that level again. They will be quite nervous because it will make European-made goods less competitive sold against the Americans. I mean, the Europeans have got a lot of trade with America, it would seem, but it will just coincides with the fact we've also got a technical level there, not only levels of support resistance, but also trendline resistance. So we have a legitimate trade. Okay, so let's go to the charts and have a look. I want to talk to you about various different ways of doing this, okay? I'm just going to ignore here. There we go. I'm just going to talk to you very quickly about supply and demand trading, because it is a style of trading which you can easily dovetail in with this central bank strategy. Regardless, this is the euro versus the Norwegian krona, by the way. Please don't get freaked out by this cross pair. A lot of people kind of like get a bit nervous when they see that I'm trading Scandinavian cross pair. Not to worry, we trade it and treat it and read it and analyze it in exactly the same way as we would if it was a major or a minor. The fact of the matter is we've got a fantastic level of resistance here, okay? And regardless of not whether this is a level that, whether it's the ECB or indeed the Norwegian's equivalent of a central bank is defending, then we could still trade this in exactly the same way in terms of having a level or an order short on the level here, our stop loss above it, the equivalent to where this red line is, and we can have our target towards the bottom of the range here. You know, this is simple stuff, by the way, simple stuff, which is often forgotten about in trading. In the Hitchhiker's Guide for the Holy Grail, a lot of people who I mentor have been around the world and back, gone to hell and back with, you know, buying and testing out every magic bullet EA there is on the marketplace, only to come back and be absolutely almost annoyed at themselves and me for the fact that they didn't find the fact that trading can be this simple, really. had only they discovered it before they got sucked into the kind of the get rich quick and all that kind of nonsense. Okay, so with this trade, it depends what kind of trader you are, really. If you're somebody who's very happy to accept a slightly higher risk, then typically you would have an order just below the level, or just on it. I'll recommend below, because if you get a whiplash reaction to the level like we did all the way back here, back in July, then you won't get filled, and you wouldn't want that to happen. So you can do it that way. And if you look at the distance between the entry and the stop loss here, then you've got if you're risking 1%, you've got roughly a 4 to 1 there, and that's not a bad. If you're risking 1%, potentially 4% to make, not bad at all. If you're risking 2%, that's potentially 8% to be made. Very easy percentage points to be made, almost like a no-brainer. People say, and it's a very good argument, by the way, and I want to rebuttal that. Here, it's popular accusation that, okay, the more tests that a level has, the weaker it is. Absolutely. This is why I want to look for a very certain kind of tests. So the tests I like to look up are the ones that are happening right now, and these are very kind of whiplash reactions. You can see here that the tests on this level of resistance, price goes up and it's almost immediately rejected. Price goes up and it's almost immediately, well, sorry, it is immediately rejected here. Price has gone up, not quite so high this time round, but it's almost, well, it's immediately rejected, isn't it? So we can anticipate it happening again. And of course, it could break out and we could lose 1%. But I will always say, if you're trading, ask yourself, if you've got a high reward to risk strategy or trade setup, ask yourself, what is the best possible thing that could happen to me if I take this trade? Well, we know that we could potentially make 4%, risking 1% of our trading account, or 8% risking 2%. But what is the worst possible thing that can happen? Well, you'll lose 1 or 2%. The reward to risk is stacked in your favor, isn't it? It's like, for example, flipping a coin. I mean, you know, black or white, heads or tails. I mean, the level could break, it might not. But it's like, okay, saying it's going to land on heads, knowing that you're going to win potentially 500 quid if it lands on heads and you're right, rather than losing 100 quid if you're wrong and it lands on tails. It's almost like that, really. And this is why I absolutely love range trades like this. A lot of people out there say, oh, well, I don't trade ranges, you know, I'm a trend trader. Fine, do what suits you. But it is just very, can give you simplicity a lot of the time. And, you know, we do get, like, for example, I'll show you this trade I'm very much in at the moment. It's gold. Of this horizontal level of support, like so. This, we've got, you can see here, this level 1180, my apologies. You can see that the profile of the rejection to it is very kind of whiplash or whipsaw. You can see that price come down, sharply rejected it and come back. Price has sharply rejected it and come back. So this is why, even if it has two previous tests, and we've got tests like that, previous tests like that, then I'm very happy to go long on the level and have a stop loss, a wide berth away. In this case, it's $20 away. We're up about 3% on this one at the moment. I've been in it for about 2 weeks. Got a futures contract long on it. And we saw that just like with Euro Swiss, we had gold, an ABCD pattern, closing into the level, like so. So we've got A to B equaling C to D, like so. So we knew, just like we mentioned with the Euro Swiss chart, we've got a potential reversal point here for the ABCD pattern, which correlates very nicely with potential buy level, which is actually, as you can see, a multi-year low. In fact, gold hasn't been at this point in over 4 years, so, or just about over 4 years. So, you know, very good level to go long. And, you know, we do get these kind of trades a lot of the time. Footsie, I know it might be off the radar for a few of you guys, if you're not based in the United Kingdom, but whatever, it's just an example of price action on an asset class. That it could be any asset class. This could be the Russian ruble, it could be pork bellies, it could be anything, okay? But we treat price action levels of support and demand supply and demand, and support and resistance in exactly the same way. Price action is universal, and so is supply-side economics when they're looking at these charts. So, for example, the Footsie, great level to go short here. I know some people did, some of my clients did take this short around about this point here, and are still in the Footsie short. Will be interesting to see if it goes down or carries upwards. Traditionally, at this time of the year, fast forward a month, the Christmas season, we do have a risk on, and they call it the Santa Claus rally. People are traditionally very bullish in equities and the equity following currency pairs towards Christmas time, so we can expect the FTSE to kind of rally upwards based on that. But at the moment, we are waiting for a potential sell based on the fact that we've got price, it's come back, it's retested, and this horizontal level of support is becoming resistance here. We're just waiting for a clear signal to go short, but we're not getting it quite yet. So we are being very, very cautious here with the FTSE in this sense. This is all we've got is a rather terrible looking pin bar, with nothing else really apart from it retesting. And everyone knows about pin bars. And just going back to the point made in the chat on the chat board earlier, if everyone knows about something, the less likely it is to be self-fulfilling in this sense. And every other Tom, Dick and Fanny knows about pin bar reversals. So, I love pin bar reversals, but I have refined things to eliminate low probability pin bar reversals compared with high probability pin bar reversals. Okay, and typically what I look for, just to share that with you, is if I get a pin bar reversal, I'm looking for a reversal pattern on the smaller time frame as well. Because it says to me, we don't have it at the moment, it says to me that, okay, we've got a pin bar reversal on the daily, so what? But if we get it on the hourly as well, or 4 hourly, it says to us that, hey, the shorter term buyers and sellers are thinking in exactly the same way as the longer term buyers and sellers as well. So we've got what we call time frame correlation here, and this is extremely important when we look at trading, okay, or looking at trading in long-term positions here. So that's the FTSE. Some people are in this one still short. The FTSE did something rather remarkable after Alex Salmond's defeat in the Scottish referendum, which was, almost. Well, I reached for the popcorn. It was almost. It had me on the edge of my seat, quite frankly. Anyway, so the FTSE momentarily spiked upwards and stopped quite a few people out who were short on the FTSE. I had a short on the FTSE because if Scotland did get their independence from the United Kingdom, then quite frankly, it's no secret that the FTSE would have bombed. I know a lot of companies would have wanted out of Scotland if that was the case, and certainly cable nosedived that evening when the opinion polls, were 1% ahead for yes, we want independence, vote. So the FTSE fell after a spike upwards, and this is where we are now. So this is also why I personally don't care about news, okay? And this is why I always recommend high reward trading with high reward potential, because essentially it's, if you're right, you're very right, but if you're wrong, you've only lost a small amount of money, essentially. For example, I'll talk to you about a trade I'm in at the moment. It's cable. And just going back to what I said about pin bar reversals, we had a week before last a bullish pin bar reversal on the weekly. So what? That means nothing on its own at all. I know there are certain traders and educators out there who get so excited when they see a pin bar reversal on its own, and to them it's very exciting, and it is an activated bar. Fantastic. It says that price has been rejected, but what is it rejected? Well, in terms of this example, it's rejected a round number 1,600. This is a number which is always prophesized and pontificated over the financial commentators in the press and in the media. 1,600, it's not necessarily a level defended by a central bank, by the way. So it's off the horizontal level, it's off this trend line, resistance now turned trend line support, and it's also, lo and behold, off this 50% retracement. It's got to the halfway stage. The cable's fallen for the past 8 to 10 weeks, but it's got to half of its way down. We could reasonably expect a movement upwards. We've got bullish reversal divergence. We've also got inverse head and shoulders on the daily time frame. So we've got time frame correlation on our favor here. So we've got bullish inverse head and shoulders supporting the bullish pin bar reversal of 2 weeks ago. And so we've got targeting. I know full well that if I've risked 1% on this trade, my entry at the top of the bar, stop loss below the low. So I've just got a police car going by. I promise you, I live in a very nice part of London. Anyway, so here, entry would have been above the high of the bar plus spread, plus an extra pip. Stop loss below the low of the bar, minus spread, minus pip. And targets just below the previous swing high, or just below 1,700 in this case. So we've got a decent 3-to-1 here. So 250 pips difference between entry and stop loss. Yeah, it's a 3-to-1 if you're risking 1%. I risk 2% on this one, so I know that this could potentially be a decent trickler trade between now and Christmas with 6% potential gain at risk 2%, but I will be managing this trade accordingly and moving my stop loss and trailing profit so that the worst possible thing that can happen is I get a free trade. Okay, so that's cable, and this is a trade idea which, you know, still valid. But in terms of currency, this year has been the first part of this year has been quite kind of innocuous, really, and suffering from inertia. In terms of euro versus the pound, let's try and find this one on my list. So I'm going to talk to you about Singapore dollar. Here we go. This is more relevant. Here we go. So this is US dollar versus the Singapore dollar. We can see here, look at it, it's done nothing apart from range sideways in a rather unspectacular, boring fashion. So it would make sense to simply sell the top of the range like so, knowing full well, long term, that if your entry is just below the level here and your stop loss is, say, 50 to 100 pips away, whether or not this level is defended by the bank or not, you know full well that, okay, if it goes against you, then you've lost 1%. But if it goes in your favor, you've got a fabulously big gain potentially on your side. But of course, this does depend on factors being in your favor, including, well, obviously dollar strength, dollar weakness, the state of affairs in America, the fundamentals underpinning it. But if you're going to get into a move, a big potential long-term move, it makes sense to get in at the very start. This is why I've got a very strong argument, and a strong element of my trading is literally setting orders on the levels as opposed to waiting for a price action based reversal on the level, because typically if they're buyers or sellers at the level, they're going to simply make themselves known very quickly rather than gently rolling out a bullish or bearish pin bar reversal, just like the good old days. So we can see here just very quickly on the Singapore dollar versus the US dollar. Sure, let's have a look on the monthly. I think we could potentially have a bearish pin bar reversal on the monthly. Yes, we do. And it will come as no surprise. And I wouldn't recommend trading the monthly, by the way. It's just an example. We can see on the daily that we've got, to support that time frame correlation, we've got a double top potentially here. We've got a rather horrible looking neckline here, a lower high, M-shaped formation essentially. So that's how you could potentially take advantage of the Singapore dollar. It's a bit late now. I would have wanted to have gotten at the very top here, at the very start of the move. The worst possible thing that could happen is the level would have broken and closed above it and invalidated the level. The best possible thing that can happen is, of course, it goes all the way down and makes you a decent chunk of profit. But of course, nothing in the market is ever guaranteed. This is why it always makes sense to essentially trade with reward on your side. Okay, so coming to the end of the main presentation, and I do obviously want to answer your questions if you have any, but I do want to share this with you. As you've all bothered to attend today, I reward people who like to take action and are serious about their trading, and I do offer a mentoring service which teaches people how to trade from as little as 10 minutes a day, and we do have a variety of cutting-edge ways to do this, including trader hypnosis, 10 hours of video tutorials, access to over 6 strategies, market analysis, and of course, one-on-one mentoring, which is optional. We share trade ideas as well. So valued at £1,997, you can get access for $97 only, for today only, using this coupon code or this promo code October 888. If you go to thelazytrader.com, which is my website, and Forex trading, and use, if you decide it's for you, it's marked down at a huge rate, it's only $97, then you can get on that program and save yourself a stack of money, and no love lost if you don't. It's all good. But this is for today only. It says open for weekend only, but this is when the last webinar is scheduled for, so please ignore that. So, yeah, I am insane. Yes, I mean, people have said that to me before. I am quite generous, but I am increasing prices soon or before Christmas. So, as I said, I like to reward action takers, but do make sure you read the terms and conditions. Have a look. No love lost if it's not for you. If anyone's got any questions, do make yourselves known. If you decide the course is not for you and you don't want to take advantage of that offer, then by all means, just go to the website anyway and download your free guide, your free pack, 5 rapid ways to become highly profitable in Forex trading, and videos as well. And I do contribute to a variety of well-known Forex publications, like Forex Trader Magazine, FX Street, as you know, Your Trading Edge in Australia, that magazine. And so, yeah, do add yourself to the mailing list as and when you can, because we do have a lot of updates. And yeah, the Trader Hypnosis audio course, you'll have to find out. We have a very renowned person in the metaphysical world who's also a successful trader who has developed this. And there's nothing else out there like it. So you can count yourself down into a trance. And this is just one of many bonuses you get with the Ultimate program. And we've had some very good reviews, by the way. So do look at our testimonials and see how it goes. Any questions, by the way? Any questions? So download it for free. Some free 5 rapid ways to become highly profitable in Forex trading. Add yourself to the mailing list if you want. So yeah, that's it really. Anyone got any questions on the presentation? I will say that if you're just going to trade horizontal levels on key levels of supply and demand, that's all you really need. And this is a style of trading which, quite frankly, enables me to go about my day without really worrying about the markets or anything else. And you can trade this style of trading on any asset class, whether it's a commodity, precious metal, stock, currency pair, you name it. You can do exactly the same thing. Okay. Any more questions? I'm just scrolling up now. S&P, well, it's exactly the same with the Footsie. We've had a rather sharp retracement on the S&P. Let's have a look. Let's go to it. Yep. And potentially on course to make a higher high yet still. This freak move, by the way, is off the back of tensions in the Middle East and Ebola. But it just seems to be a bit of an anomaly. But I am a little bit concerned with the way that we are seeing moving averages converging and crossing over each other, starting to kind of top out. But give it to you for free. You won't value it if you've got it for free, but I do offer a full money back guarantee. So if you're not 100% satisfied, you can get your money back, no problem. So if you're one of those people, then see your question. FX Boyke, where is your question, please? I'm just scrolling up to see. Where do I enter and exit? Okay, right, sure, no problem. Well, I mean, typically if I get a pin bar reversal, bullish or bearish pin bar reversal, say if it's a bullish pin bar reversal, I'll have my entry above the high of the bar with my stop loss below the low, and I'll take it from there. If it's on the level, I'll put it, if I'm going long, I'll put the order to go long in advance of the level, just above it with my stop loss, give it a wide berth below it, between a 50 and 100 pips, depending on how aggressive I want to be. Data releases and news. Well, the great news is, FX Boyke, I don't care about news. It doesn't matter to me one jot. All I do is I simply, I don't even care when non-farm payroll day is, quite frankly, because I know full well that the trade setups, which I get into, have their own merits when I take them. I know that if I'm right, then I could potentially make a decent percentage gain, but if I'm wrong, the risk on them is limited to 1 or 2%. So if I'm right, I'm very right, and I make good percentage points and a good number of pips, but if I'm wrong, at least my downside is limited. So that's how I handle with news. I actually don't care. In fact, I'm very happy not to even care who is managing the Fed, or whether it's Greenspan or whoever. It doesn't matter to me at all, or the Bank of England. I am concerned about, or interested in, the level central banks defend, but that's it, really. So I trade the daily charts, absolutely, and I trade the weekly as well. Okay. Any more questions about trading? You're welcome. Do sign up to the website, whether you're a free subscriber or whether you do want to come on board our mentoring service. Hope to see you there, and happy trading in the meantime.